Welcome to Real Vision's Trade Ideas. Today we're sitting down with John Kolovos of Macro Risk Advisors. It's great to have you here.
Thank you for having me.
So you were here about 6 weeks ago and you were quite bullish on the S&P 500. You saw it in this long-term trend channel. You had a year-end target of 30.65 and a stop loss at 28.50. Since then, we've had a lot of things going on in the markets. We had the sell-off in May. It's rebounded up past 2,900. Mm-hmm. Could you give us a little bit of an update as to what your levels are right now?
Okay, sure. First and foremost, thanks for having me again. And number two, I would say, my objective for the S&P 500 is still the same. All right, 30.65, could even see it as high as 3,100. The pullback that we saw in May was just that, a pullback, a minor correction. We saw an acceleration in downside momentum, but not enough to tilt trend. So trend is still positive, and I still want to stay on the side of trend.
In terms of staying on the side of trend, what technicals are you looking at right now?
Sure. So I'd say this market's strongest attribute here right now, besides trend, is sentiment, right? And I would say that sentiment is so bearish right now that is as bearish as it was back at the cyclical bear market low of 2016. And one indicator that I look at is the AAII bull-bear ratio. And that is, like I said, at the same level as it was back in 2016. We're only a couple percentage points away from a new all-time high. Yet sentiment is as if we were at a multi-year low. So to me, I want to look at the other side and be contrarian, so sentiment is quite compelling. Also, on the sentiment front, the put-call ratio during the May pullback reached about 3 standard deviation levels. You want to be on the other side of that, so on a put-call basis, that was quite high. Also, the bond VIX, right, the MOVE index, also hit about a 3 or 4 standard deviation level. When you have the combination of your put-call spiking and your MOVE index spiking, you tend to have very positive forward returns for the S&P 500. So sentiment would be the other indicator that I'll be looking at. And the other category of indicators I'll be watching closely would be, is momentum. Okay, so as we came down to around that 2,700 level on the S&P 500 during the May pullback, market almost responded exactly what it was supposed to, okay? I wrote in my reports that the markets move and as part of a 3-act play, right? You have an initial down move, which is Act 1. Act 2 would be the oversold rally, and then Act 3 would be the lower low, okay? And that's what corrections are. They tend to be a 3-part sequence. And the way you measured it, a technician will come up with a measured objective or whatever, and you get down to around this 2,700 level. That's where we got to, and the market responded off of it. And then when it responded off of it, it responded off with a very robust price momentum, right? And also with very strong advanced decline ratios. We had like a 90% day right off the low. We were able to shoot up higher to about where we are right now. So price momentum has been very, very strong. And then lastly, how is this pullback, the one we had in May, different than what we saw back in 2018? And I think this is important to think about, is that if you were to overlay the pullback that started in May, actually the pullback that turned into a bear market, in October with what we see right here in May, they're almost one and the same. They both broke down from wedge formations, and they both went through this 1, 2, 3 sequence, Act 1, 2, and 3. What happened in 2018 is that we actually had breadth divergences. Like the AD line, right, was already declining while the market was going up, okay? Currently, when the market made a new high, an all-time high, breadth confirmed. So the market was on a stronger footing now than it was then. So I'm inclined to be buying this pullback versus what happened last year. So I'm looking at breadth, I'm looking at momentum, and I'm also looking at sentiment.
Okay, and right now, do you see that rally potentially happening sooner than later, or do you think for a while we're just going to kind of muddle through?
I think it's going to be a little bit of a muddle through. We have summer seasonality to deal with. We have a lot of catalysts ahead. We have G20 meeting. We still have the Fed coming up in a couple days. So there's a lot of that going on. We also have the July employment data that needs to come out. Market has to figure out what to do with that. So I think it's going to be muddle along, but eventually we'll make the higher high and make a push up to 30.65.
Is your stop loss still in the same area at 28.50?
It is. It is actually, yeah. I have it as 28.60. It adjusts a little bit, but we'll call it 28.50. It's fine enough.
And technicals there, is there a point that people should be watching for in the stock market to say, I got to back out?
Yeah, I believe underneath 28.60 will prove to the marketplace that the correction that we went through in May is still ongoing, and that a break underneath that level will tell us, well, you know what, we need to go back down to around 2,700 and test the level that I have been calling as trend-defining support. So anything underneath that 2,700 level, we start questioning the trend models I was referring to earlier, that perhaps we need to become a little bit neutral-ish, if not become a bit negative.
Okay, so if you were looking to trade this in the SPY, what levels would you be looking
So
at?
SPY, that's approximately 310 on the SPY as a target, and for the stop would be around 285.
Given that we are kind of potentially going to see sort of a muddle through period, would you consider putting a hedge on that trade?
Yeah, I would actually, and what's quite interesting when it comes to gold, for instance, I think is one hedge we can put on. One thing I've been telling the clients and even in my written reports is this: if you were just to cover up, the price, the label for gold, right, on your Bloomberg chart or wherever, you say, oh, what is that? It's quite compelling. It's an interesting chart. You should be long it, regardless of what asset class it is. So on a short-term basis, gold looks very interesting to me. But it's only a tactical idea. It's only a hedge. It's not a strategic long-term idea. And the reason being is if you were to look at a long-term picture of gold, it's been basing for about 4 or 5 years, okay, underneath this 1350 to 1375 resistance level. It's a base, and technicians get very excited about these bases, but it's still a base until it breaks out, and it hasn't broken out yet. So from a tactical standpoint, I think we can push up and test those levels and maybe continue a little bit of the short-term momentum that we've seen, but longer term, it's hard to become bullish on gold until we break out above that level. And one last thing is that with gold, if you would look at the ratio of stocks to gold, right, the stock to gold ratio, that is actually giving a tactical sell signal, okay? So I do want to be hedged a bit when gold is outperforming stocks, which it is right now on a short-term basis.
So just to follow up on that chart that you mentioned of stocks versus gold, stocks are underperforming gold on a short-term basis, but what about a long-term?
A long-term basis, no, stocks are still outperforming gold. A great indicator that technicians have used for decades is to look at the stock to gold ratio on a monthly basis, and if you overlay it with, say, a 50-month moving average, okay, if that ratio is above trend, you're in a secular bull market. If you're below trend, you're in a secular bear market. So while stocks have lost momentum relative to gold, the trend is not negative. So I just want to make it clear that on a structural basis, stocks are still on an uptrend, and down the road, if things start to turn south for stocks, I'll be watching this quite closely to tell me whether or not maybe stocks are turning into more of a prolonged bear market or not.
And looking at a price chart of gold, you have mentioned in notes that even a gold rally up to 1,700 would still mean that there's a secular bear market for gold.
It's right. So even last time I was here, we talked about oil, how I think oil will continue to move lower. Why? Because it's a secular bear market, and same with gold, right? Gold, I believe, is in a secular bear market. So if gold were to break out, let's say above this 1375 level, it counts to 1,700. It's a nice rally. It's a strong move, but it still would keep gold within the definition of a bear market, a secular bear market, a decade of just volatile, sideways trading, and it would be very similar to what we saw back in the 80s.
So is this gold trade just a short-term tactical trade rather than watching it get up to 1,700?
Correct, yes. I wouldn't be surprised to see it get up that high on a sustained breakout, but as of right now, I'm treating strength right now in gold as a tactical position.
Okay, so what would you be looking for to actually see it get up to 1,700?
Okay, so there is actually an inverse relationship between gold and real interest rates, okay? So gold is bumping up against major resistance around this 1350, 1375 level. The real rates on the 10-year, has strong support at around 30 basis points right now. So for gold to break out, real rates would really have to break down. And the market right now is supporting interest rates at that level. Okay, if the Fed does cut, and let's say they continue to cut, it's quite possible real rates head closer to negative, and that would be a tailwind for gold. But I'm going to wait for confirmation from gold breaking out to position better for the 1,700, and also look for real rates to confirm the breakout.
And what about your stop loss?
So for gold, I would say the stop, and actually I came prepared more to talk about the GLD.
Sure.
I would say the target for GLD would be around 137 to around 140, with the stop being at around 123.
And are there other asset classes that you would use to hedge?
I would be looking at bonds as well, okay? In particular, I think individuals can be long the TLT, just a small position. I think given the uncertainty that we're in right now, having some sort of hedge on, I think, is totally fine, okay? And the reason being, if you kind of think about it, the market only really gives us a tremendous buying opportunity once every couple of years. And I believe that buying opportunity happened in December of 2018. And now we're much, much higher. Okay, now you have to be a little bit more careful, I guess, about your spots and how you play it. But also, we're almost at a new high, okay, for the market. And I think the market's really going to test, the participants' will, whether or not they're going to allow it to break out. So I think it's a good idea just to kind of keep a bit of a hedge in the TLT. Would be one.
So what technicals are you looking at in TLT?
TLT, honestly, the first and foremost is just a price trend for the TLT. It is just compelling. It broke out of a small base about a month and a half ago, and it's just been trucking along beautifully since then. Just like gold, if you were just to hide the ticker on your screen and try to guess what stock that was, you would think it was a tech company or a biotech company. No, it's bonds, right? So it's very, very strong. So really, it's trend and momentum that's keeping me on the long side of bonds.
Okay. So talk about some of your levels. What's your entry and your target and stop loss?
So sure, for a short-term perspective, I would look at around 134.5 for the TLT. There is scope to get to 140. I know that's a bit aggressive, but I would say somewhere around 134.5 would be the initial level to look at. As for stops, I would say 130.25 would be a good stop, or longer term, the 50-day moving average. Okay, I think the 50-day moving average for the TLT could be a good trailing stop over time.
And in terms of time frame for both TLT and GLD, what are you looking at?
I would say just over a course of a couple months, honestly. Like I said, this is a tactical concern, right? And as we just back up a little bit and just think about what other things I'm looking at for bonds, interest rates should, in theory, try to find a floor around here, at least temporarily, around 2% on the 10-year. I know I'm saying this before a Fed meeting, but when I look at the price, I should say the chart of copper, right? Copper is testing a major support level. As I mentioned earlier, gold is testing a major resistance level, right? So my process tells me to respect my levels, right? I'm going to assume that support's going to hold. I'm going to assume that resistance could very well hold, okay? And when you combine the two, copper and gold, you have the copper-gold ratio, and the copper-gold ratio actually correlates pretty well with interest rates. So if the copper-gold ratio is oversold in that support, then interest rates should be oversold in that support, and therefore rates go up, and then bonds should eventually find its way lower. So that's why I think it's more of a tactical issue being long bonds than a longer term, because like I said, the longer term support levels are legit for copper.
Gotcha. Now, you mentioned the Fed, and we have a big Fed meeting coming up. What would be your response either way? Let's say the Fed is more hawkish or comes out more dovish. How would you react to that?
Honestly, I would wait till the dust settles, right? We're dealing with an all-time high for the stock market. I think the market's going to really test the will of its participants. That's what it's going to do. I wouldn't be surprised to see the market be volatile in both directions, okay? Both on the upside and the downside. I think the algos will go one wild, the minutes after the statement gets released. I wouldn't act on that immediately. I would wait, look at your levels, be mindful of your levels, and then act accordingly after the event happens. It's not a good idea usually to just act right away. You have to think about it. And again, I always tell everybody, just watch your levels, be mindful of them.
And in terms of a G20 meeting, how do you see that potentially impacting your hedges or potentially the markets?
Well, if it's a positive outcome, right, we should see gold come in, right? We should see, bonds come in and then stock market move up. One thing that I try to do, and I advise our clients, is that you got to be incremental, right? There's no rule out there that says on day one you have to be 500 basis points overweight a position on day one. You can incrementally change your positioning, right? So if the outcome is positive, right, we take back our hedges and then we, stay with our core long positions. If it turns out to be a negative event, even with the Fed, right, what was a hedge could eventually evolve into a strategic longer term position, right? So it's all incremental. It doesn't have to be a binary. Okay, I'm long stocks today, and I'm going to be, short bonds tomorrow.
All right, can you summarize your entire trade thesis in 30 seconds?
Sure, I can. So for the S&P 500, I would be looking for 3065 to 3100 as the upside objective, with the stock being at around 28.60. I do want to just make it clear as well that that trend-defining support level is somewhere around that 2,700 level. So if markets do roll over, that will be in a very, very important spot to be mindful of on an intermediate-term basis. For the second trade would be GLD, right? 137 to 140 would be the upside objective, with support being at 123. And as for bonds, the TLT, we have a short-term objective at 134.5. 140 is possible, with the stop at 130.25 and 127 being the 50-day moving average.
Great. John, thank you so much.
Thank you for having me.
So John is still bullish on the stock market. He suggests buying the SPDR S&P 500 ETF at current levels with a stop loss at 285 and a target price of 310 by the end of the year. In addition, he's also bullish on bonds and gold and likes buying them as hedges. Specifically, he likes buying the iShares Treasury Bond ETF, ticker symbol TLT, at current levels with a stop loss at 130.25 and 127, and a target price of 134.50 over the next few months. He thinks it could go as high as 140. And finally, John suggests buying gold for a tactical trade. Specifically, he likes buying the SPDR Gold ETF, ticker symbol GLD, at current levels with a stop loss at 123 and a target price of 137 over the next few months. Just remember, this is a trade idea and not investment advice. You should do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.